The tide is rising, Tiger Lily. Well, actually, the yield on Treasury bills, notes, and more importantly, 10-year bonds is rising. What we're seeing here is the bond market react to the belief that the U.S. economy and the global economy in general is getting better and that inflation down the road is going to be higher. On December 8th, the yield on the 10-year Treasury hit briefly 3.33%. Doesn't sound very high, but certainly if you look at the trend, we're seeing the price of Treasuries fall and yields go up. Now, this is a good sign that investors are feeling, well, okay about the economy, okay about the prospects that the U.S. economic growth is going to pick up, and that inflation is going to pick up. So you really got people saying, well, holding for 10 years or however long people are actually going to hold these things, a lot of this is just trading, over the holding period, I really want to get paid more because I think inflation is going to take a bigger bite out of the value of that income stream. All this really suggests that the Fed has a really big dilemma right now. Remember, the Fed is in the early stages of a $600 billion program called Quantitative Easing 2, or QE2. I joke because it's so hard to turn around or steer because it's so big, just like an ocean liner. They're in the middle of a program that would buy all these Treasury 10-year and 7-year bonds. The idea was they would go out and buy them, and that would drive interest rates lower, and this would help the economy, particularly the housing sector. Well, the Fed may be buying, but what we're seeing is that the Fed is getting overwhelmed by feelings about inflation and the economy in general. So the Fed isn't actually driving down interest rates on mortgages, which are tied to 10-year Treasuries, but they're seeing them rise. So what does the Fed do? At the moment, the Fed is not doing anything because the Fed feels, well, with the renewal probably of the Bush tax cuts and a couple of whistles and bells added to that program, plus the general feeling that the economy is doing okay and the stock market going up, we really don't need to add a whole lot more stimulus. But it really does raise the question of, well, what is that $600 billion doing? Does the Fed really need to spend it? And on the other hand, from the other point of view, if the Fed wasn't doing all that buying to drive down yields, where would yields be right now? This is Jim Jubak.